Hello and welcome back to Market Shares. I'm your host, Tony Blodgett, and today we are in for our, let's say quarterly dose of real estate update with Anton Stetner. Anton, welcome back.
Thank you, sir.
To the show. To the show. Is it a program? It's a podcast? It's something, but welcome back either way. Anton, for those of you who watch on a regular basis, is a local real estate investor, real estate agent, brokerage owner, and all of the above. I would say all-around real estate expert. When I have questions about what's going on in the real estate market, I call Anton. When I need advice on an investment opportunity that lands in my lap, I call Anton. He is just a well-rounded dude and someone that is a friend of mine, and we just love chatting about this real estate stuff. So I like to always pepper in an episode where we talk kind of what's real time, what's going on with the market. And so we're going to dig right into that today. Anton, where I wanted to start was at the time of recording this, we're halfway through the month of May, almost at the end of May. That puts us 2/3 through the second quarter. This is our spring home buying season. So my question for you is, how does this feel in relationship to a typical spring buying season? Is it better than we expected? Is it worse than we expected? Is it pretty average? What are you seeing out there in real time?
In real time, I think what we're seeing today is the market is beating expectations on appreciation. We did not expect. So last year, Benji asked me a question. He said, "Hey, what's your prediction for 2024?" I was like, man, we might get 3%, 5%, maybe 6% if we're lucky. I feel like we're in a year of single-digit appreciation. What we've actually seen this year throughout most of the Seattle metro is we're seeing double-digit appreciation year to date. King County, which is the heart of Seattle, is actually already above where it was in 2022.
So year to date, we're seeing double digit.
Year to date. So King County is at a little over 13. And Snohomish County, where we're at currently, is a little over 10. That's amazing. King County is above where we peaked in 2022, and then Snohomish County is still a little bit under that. And going back to your question, you said, what's happening? Is this a normal spring market? Yes, we're experiencing the normal spring market of the weather gets nice, everyone wants to buy, everyone wants to list their home, and the activity has definitely increased. What's not normal is you're not getting that normal rise in inventory. So normally inventory starts rising about May and then kind of rises until June or July, somewhere in the summer. Inventory did rise, but just a little bit this year. And I think that's partly because of the lock-in effect.
Right.
I think that lock-in effect is keeping people from listing their home. Try to tell someone, hey, you've got a 4% mortgage, let's go trade it in for a 7%. That's hard for them to do. What we are seeing though is that just started showing up. So there was kind of like a lull right there at the beginning of the year, first quarter. And then all of a sudden, second quarter started really hitting. And so I think we're finishing second quarter stronger. Bidding wars are back.
Yeah.
I'm sure all of you loan officers, all of you real estate people are feeling it. If you have a buyer, it's hard for a buyer to purchase right now.
So we see the typical spring buyers coming, but we're not seeing the typical inventory come with it, which we kind of expected, but that's playing out the way that we thought it might with the lock-in effect.
Yeah, and there's not enough new construction builder inventory to kind of make up that gap. What's interesting is new construction across the whole U.S., though, is making up a larger percentage of the market.
Yeah, it's like 35% of transactions, I think, or something.
Bingo.
Yeah.
And normally it's, in the 20s. It varies between like 18 to 25. So it's making up 10 to 15% more of the market. Here locally, of course, we just don't have enough new construction. What we're seeing, though, is closings are slightly above 2023, but pendings are up about 20 to 25%, depending on where you're looking at. What that means is those closings are going to start to show up. And so 2024, assuming everything goes okay with the election, when we have an election year, the thing for our listeners to be, this is the data you should be paying attention to. Generally speaking, about 45 days, 60 days before the election, the fear of the unknown causes the market to slow down slightly.
Right.
So for our investors, that's a buying time. And for the buyers who maybe got beat out there during summer or end of summer, that may also be another buying time.
So September, October could actually be a really good opportunity.
Generally, every election cycle it is. And so generally as hardcore investors, we try to pick up literally in the month before the election. And then of course, right after the election there in the winter. And so this year, I expect us to finish slightly above 2023, and 2023 was a beat up year. 2023, and we'll do slightly better than 2022. But across the U.S., we're just hovering right around 4 million transactions. I don't expect a big increase in transaction volume until rates come down.
Yeah. Well, it's interesting. You mentioned the local market here, kind of revisiting those highs as far as home values. We're seeing the same thing. I looked at a report nationally. We're actually just above what the peak was right now, which is just astonishing. And, I think the comment to that is, gosh, what's going to happen with these home values when rates do drop? Because, if there's this much kind of pent up demand, no inventory, bidding wars with rates where they're at, which is, close to all-time highs, I can only imagine. And affordability is not, it's horrible. But yet there's still people that are pushing to get into these homes. So it'll be interesting to see what happens. I still think look, if you can pull it together and buy a home now, it's still going to be a really great, not only home for your family, probably more expensive than you were hoping, but it will be a good long-term investment. And there is opportunities at some point in the future, more than likely, to restructure, the debt that, against that house. And so,
absolutely.
It's funny, I got to call this out because, a year and a half ago, if you remember the whole, buy the house, date the rate thing. And, that was everyone's tagline.
This has turned into a long-term commitment.
Well, that's not really my point. But what's funny is I see all these auto commercials now for cars.
Yes.
And they're saying, buy the home, date the rent. There's a bunch of, and I'm like, that's old news. We were doing that in the mortgage business, 2 years ago. But to me, that has not turned out to be, well, here, I'll be honest with you. When I think of, marry the home, date the rate, I never expected that to be a 12-month thing. That just, to me, that just means, look, at some point in the future, you're going to be able to restructure your debt. And in my opinion, that hasn't changed. Some people probably thought that would happen in 6 months or 12 months. If you made a decision based on that, A, you're probably not that happy, and B, that probably wasn't the smartest decision.
And I think this is one of those times when I want our listeners, our friends, the audience, go back in history and look at what's happened during recessionary times, what's happened during elections, and how the Fed has responded to inflation. If we just go back and look, every time they've responded to inflation, it never happened quickly.
Right.
So if you look at the past, and now it's not going to be exactly the same in the future, but that'll give you an indication of, you should know this was going to take a minimum of 2 years, maybe 3 years, maybe 3.5 for this to work its way through the system.
Yeah.
I think we've just become impatient because of, our cell phones and having access to technology all the time. One thing I also want people to be thinking about, as we were talking about the home buyer and the home seller, realize, and this will sound controversial, people should be thinking about investing today. And the reason they should be thinking about investing in real estate is most people are not thinking about investing in real estate due to the high rates. So they can get a deal or an opportunity today by negotiating better terms and then preparing themselves. So in other words, don't be stupid, but buy something that works. So when rates do come down, your good deal turns into a great deal.
Right.
And I think a lot of people are going to miss out on 2024 is probably the time to be seriously considering purchasing investment properties, even though it doesn't feel good. But that's the reason.
Right.
It's that lack of competition. It's that lack of rapid appreciation. It's the fact that cap rates have gone up and compressed multifamilies right now. That's a buying opportunity.
Right. That makes sense. That was actually the next thing on my list is what are the opportunities, for investors. So you jumped ahead of me, but so it sounds like now when you because look, if you're buying a single family home though, it sounds like there is some competition there
Yes.
because you're first time home buyer and is competing against the investor for those homes. So are you thinking more like maybe homes that are in disrepair that need some repair
Yes.
might be good opportunities? Because a lot of first time home buyers aren't going to be attracted to those opportunities in a lot of cases. And then it sounds like you're talking about like small, mid-size multifamily.
Yeah. So let me break this into buckets. Where's everyone hunting right now? Everyone is hunting on the MLS within 25% of the median price.
Right.
Okay, that's the majority of the real estate market. So if that's what everyone is buying, I want to get outside of that bucket and go over here. So you mentioned, let's call it distressed.
Right.
Distressed could be, foreclosure, divorce, death, or condition.
Right.
So anything that's creating distress, let's put that in one bucket. Now let's look at a second bucket and call that one just multifamily in general. Multifamily as a sector is actually pretty beat up right now because of these high interest rates. So just go try to buy a duplex anywhere here in the Seattle metro. How much would I have to put down in order to just break even right now?
Yeah, a lot.
40%?
Probably, yeah.
Okay. That's so much money that duplex market is not turning over as fast, which means there's less demand. Well, just take that same idea of the duplex and play it out to larger, just move right up the food chain. That same thing is going to play up into 50 unit, 100 unit complexes. So very bullish on multifamily right now because of that exact problem. Yes, I may have to put more down for a moment in time, but I'm going to get a better deal. And then when everyone qualifies, is the price going to go up or down?
Up. So the high interest rate is impacting the cap rate on these projects.
Bingo.
Yeah.
So cap rates got to a low here in the Seattle metro of, I think we were trading around an average of like 3.8%, which is really low.
Right.
Cap rates are now almost 5%. So let's assume we don't go back to where we were and you could buy something at a 5.5. So if you bought $1 million property and it was trading at a 5.5, and then all of a sudden 3 years later, just because of interest rates, or 24 months later, it's now trading at a 4.
Right.
Look at, you just created 20% worth of value by doing zero work.
Right. Yeah.
Just simply the change of debt structure.
Yeah.
So one of our mutual friends, another very large investor, him and I were just having a conversation. He's talking about selling properties in the Midwest because of their, they great cash flow, but they're not going to be high appreciation, and then moving it back to the Seattle metro to capitalize on the appreciation in this market.
Yeah.
And I think that's one of the bigger plays. The fourth bucket is going to be anything that creates inventory, especially here in the Seattle metro. So inventory creation could be building a house, installing a manufactured home. It could be buying a home and adding a accessory dwelling unit to it.
Yeah.
Or a DADU, a detached accessory dwelling unit, or subdividing the land. There is so much demand for new construction. So I've been doing land, new construction stuff for 20 years here. I am getting calls on a weekly basis of people who just know this is what I do. And they go, "Hey, Anton, what do you got hiding in your pocket? You got a permit over there? You got a development?" I'm a small to a medium fish. I'm not the big guy. This is the first time in my career where big builders have called me asking for, "Do you got 2 permits? You got 1? It's because that's how much they're hunting for inventory.
Right.
So I think that inventory creation is also going to be a phenomenal wealth creation vehicle over the next 5 years here in our metro.
Yeah. And I think that's for your typical investor. It's hard to see some of those opportunities because they don't know which lots they could buy a home. And you do these all the time. You could buy a property, divide it,
Yep.
sell the existing home, either develop it or sell off that lot separately. Like, that's like a normal Tuesday for you. But for the average investor, they don't think about those opportunities. Yes. Matter of fact, a lot of the ones that you get are really properties that people had no idea that could even be done. And, you determine that it could be done, or you're looking in markets where it's typical that those lot sizes and zonings have changed, and you can find these opportunities. So you guys, if you're an investor or you want to get into investing, Anton makes a really good point, is it's probably not where you would normally think to look. And so you got to work with an agent who really understands those buckets that are outside of the normal market, and do some research, watch podcasts, with investors, people who specialize in this stuff. But there is opportunities out there. There's always opportunities out there, but the target moves depending on the market conditions, and you got to stay on top of it.
And it moves every 90 days, every 6 months. It moves quickly.
Right. Which is why we have you on here every 90 days. We got to find out what's really going on in real time. All right, so the next couple, I want to hit a few more things. I want to talk about the NAR settlement. This has been beat to death by everybody on every podcast, so I don't want to go into the details of the NAR settlement. What I want to understand, Anton, is you're an agent. You represent buyers all the time.
Yes.
You own a brokerage. How is this working in practice? Now, we're in Washington State, which I want to caveat here. Washington State was a little bit ahead of all this. They changed their rules in our Northwest Multiple Listing Service on how commissions were shown on the purchase and sale contract. I mean, they were pretty far ahead of these lawsuits. It was as a result of the coming lawsuits, but nonetheless, they were ahead of it. But how is this playing out in real time? What are you seeing? Obviously, Washington State is, I'm assuming, adopting the same kind of policies we're seeing across the country of, you're not showing homes without getting a signed buyer's representation agreement. But, how's this negotiation going on the commissions? How educated does the public seem to be about this? Like, what's your take on how this, not what happened, but how's it playing out in real life?
Yeah, no, I love it. It's a phenomenal question. What we generally get is some sort of interesting carte blanche statement like, are you paying any commissions? Do we have to pay any commissions? What's happening right now? So number one, the thing to understand is the NAR settlement does not directly affect the state of Washington. There are quite a few MLSs that are owned by the National Association of Realtors.
Right. So they're not even owned by NAR.
No. So we are a member-owned MLS, owned by what used to be agents, which is now brokers. So we're not directly tied to this. However, because of the leadership at the NWMLS, they chose to react and to take action. So in the lawsuit itself, the NWMLS, which covers, 80% of the state here in Washington, is actually referenced in the lawsuit saying this is a good example of where we think the country should be going. So the NWMLS here, what we started doing was we started breaking out, this is the buy side, this is the seller side, this is when someone's represented, this is when someone's not represented on the listing paperwork to kind of clearly define commissions. On the buyer side, I'm actually pretty excited about this. And here's what I mean. Before, I think a lot of what happened was people would go, you're a real estate agent, you're my friend, let's do business. I don't know that that's the best method of making one of the largest purchases or an investment, because there was no qualifying of the individual doing it. So for instance, if you're going to, get a remodel done on your house, you're going to maybe get some testimonials, you're going to look up some reviews, you're going to figure out, is this a good contractor? People didn't seem to do that as much with real estate agents. So one, I think this is good for the consumer. Two, this is good for the agents too, because now we have the ability to clearly articulate market differentiators of value.
Right.
Versus before, they were like, well, you're all agents. Now, you have to clearly define upfront your services, what you're doing, and what you are charging for them. Then that buyer gets to decide, am I paying for these services, regardless of if the seller is offering to pay for them or not? So what this means to me is it means there are certain individual agents who are so skilled at their job. They're so good. They're going to be able to charge above market rate. And let's just say market rate is 3% or 2.5%. These agents are so skilled, they may charge 3, 4, 5, or even 10%. Also, agents have batting averages. They're called the list to sales price ratio. You can pull it right out of the MLS. You can see what they get off. I am a hardcore negotiator. We've done deals together.
Yes, we have.
I've gotten you amazing deals. I've gotten us amazing deals. And that shows up in our batting average in the MLS. So there's people who could literally lay their batting average on the table and say, look, I net my buyer 2% more, 3% more than my fee versus the average agent with the seller. So also, I think it's going to break into this idea of like, you know, I don't represent luxury condos. It's not something I personally do. And if someone came to me and I was representing them as a buyer and they would say, what is your experience in representing luxury condos? And we're having that commission negotiation. I may say, you know what? Bill over here represents luxury condo buyers. I don't. I'd like to introduce you to Bill because I think they're going to be a better fit.
Right.
Now, conversely, if we're going to do hard deals, investment projects, land development projects, big commercial pieces, things that have multiple moving parts, like one of the deals I'm doing right now is literally selling 6 pieces of real estate and funneling it towards one.
Right.
The average agent can't do that.
Right.
Or they're not going to maximize the seller's return. And I believe this is where the consumer's winning, but also for the skilled agent,
right,
it's going to allow them to win too.
Yeah, I mean, if you can assemble multiple different sellers to get a larger piece put together and negotiated for one of your investors,
yes,
what's that worth? I mean, that's worth
millions,
a lot more than your standard commission. So yeah, you make a really good point there. I want to go back to the whole batting average thing.
Yeah.
Do you think it's appropriate for a buyer when they're interviewing an agent to ask for some of their stats? I mean,
1,000%.
Okay.
So just like we know professional athlete stats, how would that be offensive? Hey, Tony, can you prove to me and show me your track record of success and how you can help me and my family get the home of my dreams? Why not?
Right.
Hey, Tony, can you show me how you've helped other investors purchase fourplexes and what you did for them? Or I want this. This is the professionalism of the conversation. So yes, I believe the industry is going to shrink. And then have you seen the National Association of Realtor numbers for Washington State?
No.
So out of all the states in the U.S., we had the largest number of people in Washington State not renew their realtor dues.
So Washington was higher than any other state?
We lost 11%.
Okay.
What that means is, well, we kind of got hit a little bit first too, so we're a little bit further ahead than the country. In other words, we started getting hit in early, kind of mid 2022 versus other people didn't.
Because the Northwest Multiple Listing Service adopting some of these policies early, or?
I think because our price points are so high, when the Fed raised rates, that's when it started. There
just wasn't enough business for them.
There
to make
wasn't
money.
enough business, so we started getting hurt versus some of the other more affordable areas.
Got it.
And that's shown up in the people paying their NAR dues. So it's already started happening, is what I'm getting at, is that the trade association, the National Association of Realtors, is shrinking. And I expect there to be less agents in the future. And that's fine. I want the professionalism to increase. And remember, I own brokerages, so it's not like...
Right.
Brokerages is you win based on the total number of agents.
Yeah, you have a vested interest in there being more agents. Yeah, I get it. Okay, so that's perfect. That was a great update on the NAR settlement. For those of you, if you happen to be a consumer, I think Anton gives some, really good advice here, which is really make sure that the buyer's agent you're working with, I mean, you're going to know clearly upfront how much you're paying them for their services.
Yes.
Make sure they're the right person that can accomplish the goals that you have, and they're committed to what it's going to take to help you find the home of your dreams with the needs that you have. Because it's not always just going to be, you know, a simple thing, and it's possible, you know, unless your best friend is like an Anton, maybe using your best friend as your realtor is not the right answer. Do your research and just know that it is going to be a different process, and you can't expect them to be able, and they should be able to articulate to you what the value is that they bring to the relationship. I mean, that's only fair. All right, so NAR settlement, we talked on that. Okay, I want to touch on the Fed and what's going on with interest rates really quick, because the Fed gave their announcement, was out like about a month ago now, and I don't even think it was over, and you and me are on the phone, and it's like, okay, here's what I heard. Tell me if I'm hearing this right? So I just want to summarize really quick for the viewer kind of what happened at the last Fed meeting, and I think that it means a lot as to what the direction is moving forward. So the general gist of it is that the Fed, you know, Jerome Powell did not cut interest rates at the, I guess it was April. It was at the end of April, right? When was that meeting?
No, it was the May meeting. So it was 2 weeks ago.
2 weeks ago. Okay, so the first part of May, and the Fed did not cut interest rates, which no surprise to us. Now, I mean, if you would have asked us 3 months ago, we would have said definitely the Fed was going to cut in May or June, but the Fed did not cut. But here's what they did that is really important, and this is what the conversation you and I had, is that they agreed to slow the runoff of their holdings. Now, this may not sound like a big deal, but keep in mind that the Fed was buying up so many mortgage-backed securities and U.S. Treasuries, and they started unwinding their balance sheet some time ago. And what that does is that puts a whole lot of supply of these bonds into the marketplace, which continues to drive the price down and the interest rates up. And so by the Fed saying that we're going to slow the amount of runoff, meaning we're going to let less of our balance sheet run off into the marketplace and continue to dilute those values, which is driving up yields and interest rates. To me, and this was the conversation we had, is that is precisely the definition of easing. That is quantitative easing by definition. The fact that they are changing their stance on how much they are letting run off. Now, it's not aggressive quantitative easing. It's not them, you know, doing it about face and now purchasing up these assets and sopping up the inventory in order to drive the price up and the rates down. But it is a pivot.
100%.
100%. And go ahead.
I think what our listeners need to know and what your listeners need to know is that you got to think of the Fed as like an aircraft carrier. An aircraft carrier is never going to be like a jet ski changing direction quickly. It's going to change. It's going to move really slow. And if you're on the deck of the boat, you may not even feel it, but it has changed direction.
Right.
So the Fed said I was selling 60 billion with a B a month. Now I'm only selling 25 billion. So when you have the largest dumper or seller slow down, that makes it easy, that brings back a little liquidity to the market. Us as professionals need to see it as the signal as the Fed is done, we're marching forward, the Fed has officially pivoted, and rates will slowly float down from here. That could take months, but it started. So that goes back to what we were talking about earlier. So if I'm the educated buyer and the educated investor, I know everyone else is going to start qualifying more from here. Therefore, I need to get my ducks in a row and start purchasing now, because demand is going to increase as rates go down. But we have no crystal ball about the speed. We just know we're somewhere in the trough of the bottom.
We would have loved for the Feds to cut rates, but the problem is there's no headlines that are going to give them the ability to do that. This is really the second best thing, though, that they could do is to slow the supply of what they're putting into the market. That is going to help, and it has helped. If you look at what interest rates have done recently, that has helped. And then you couple that with the CPI report we saw last month, and a little bit weaker retail sales report. All of a sudden, you start going, "Oh my gosh, okay, we're starting to see those things that could be meaningful." So do the Feds cut this year? I still think that there will be a cut this year. Many people are anticipating there won't be a cut. It doesn't really matter. What does matter is that, well, and this is what I said to you earlier before the show, I truly believe that the Fed is just looking for any reason to be able to cut rates. The problem is we're not giving it to them. The economic reports are not giving them a reason to cut rates, but they want to. And as soon as, inflation just isn't going to get to their target, the employment numbers continue to be strong. It's like, gosh, they're like, man, I really wish we could cut rates. This is about all they could do without kind of creating this feeling like they're being too dovish. But they want to be dovish. They're just praying for a reason. So we'll see how that plays out. And so anyway, I just wanted to touch on that because people think, oh man, the Fed's not doing anything, but it's kind of like if you miss the headline, you got to look at kind of what was happening behind the scenes. And although it was a small piece, it was significant.
It was significant. And then there's one other thing that, so then Jerome Powell, like the next week after that, he's talking about, because inflation breaks into into buckets again. You've got goods, services, and housing, essentially. He said something during that next speech that really struck a chord with me because it was a second change in tune in literally less than a week. He said, we don't need everything to be at 2%. For us to start cutting. In other words, the Fed is now starting to focus on their dual mandate because their dual mandate is also full employment, and you're seeing signs of the economy cracking in the background with high credit card debt, auto loan delinquencies, blah, blah, blah. And so when he said that, I felt like that was another signal to our investors, to our home buyers, like, hey, we've started. We're not even going to get all the way to 2 before we start cutting, because that's also what gives the landing.
Right.
See, people keep thinking like, oh, we're going to go all the way to 2, then we're going to cut.
No.
The Fed doesn't want to be stuck in a long-term restrictive stance. So as inflation comes down and it becomes more restrictive, they can cut and still be the same amount of restrictive on their policy.
Right. Yeah, I fully believe once we see it under 3%, which has not happened, I think it actually ticked up year over year. The core inflation number that the Fed likes to watch actually went up a little bit, but I think as soon as it dips below 3, I think we're going to see a cut. But I think it was at 3.3 or 3.4.
Yeah, low 3s.
Yeah, it's in the low 3s. So we're just not there yet. But you're right. And look, They want to cut. We just need to see the signs in the economy, and the employment. That just I'm not even going to get it. That's a whole other episode. Maybe I can bring on an expert to unpack these employment numbers because they don't make a lot of sense, if I'm being honest with you. All right, so 2 other things.
So they might be cooking the books.
I mean, I'm not going to go there, but something doesn't add up, right? I don't know. All right, so we touched last year on this idea of an asset MeltUp.
Yeah.
That was kind of your phrase that you used. Maybe remind our viewers about what is an asset MeltUp, and it kind of feels like we might be seeing that play out as we speak, literally here today in 2024.
So at first I thought this was just like economic theory. And no, I'm serious. Like, oh, this is something they talk about in a book. This could never happen. So the idea of an asset melt-up is there's essentially what's called a K-shaped recovery. And a K-shaped recovery is where it breaks into 2. The people with assets just keep going up, and then the middle starts going down. So part of the middle class gets chopped out and slid down. And they slide down a economic level. But those with assets essentially keep rising regardless of where we sit in a recessionary time. And so I was thinking about this and having conversations with, a lot of our super smart friends that we have. And I go, wait a second. prices are showing double-digit appreciation here in the Seattle metro with the highest interest rates we've ever seen and the worst affordability. The stock market is just killing it and like getting ready to crest all-time highs again. Bitcoin.
Yeah. Yesterday was a good day.
Bitcoin's just destroying it right now. And so you look at this and you go, wait a second. We printed so many trillions of dollars that these asset values in general, just all across the board. So I'm talking commodities, real estate, Bitcoin, stocks, whatever it may be, are all just, there's this pressure. And this pressure is all those dollars that are sitting at, that are devalued, are pushing them higher. So you're seeing the stock market go up and up and up, and you see NVIDIA trading for something like 60 times earnings. But you still have analysts going, to the moon, let's moon boy with it. And you go, is that possible? I don't know. I don't know if that's a good stock pick or not, but it's actually possible it could keep going higher. So I think we're seeing this asset melt up happen right in front of our eyes, because even when we don't look at the Seattle metro, when we look at real estate nationally, the median price is up almost 6%.
Right.
That's outpacing a normal year. That shouldn't be happening with rates this high. So then you go, why? Well, it's the devaluing of the currency. And when we printed all that money, the money comes into everyone's hands, right? And the people who need something go buy the thing they need. And the people who don't need something actually go, well, you know, I didn't need the money from the government, and they invest it. So you had more dollars chasing less goods, services, assets. Therefore, they all rose.
Right.
And so we're seeing that K-shaped recovery happen right in front of our eyes, because it may feel like we're all making a little more money than people with assets, but it doesn't necessarily feel good. And the people without assets are going, oh my goodness, I'm getting crushed by inflation, gas, grocery prices, things of that nature. So that's what we're talking about. And I think we're seeing it.
Yeah. I mean, it doesn't sound super healthy for the overall, society as a whole. I'm just gonna say this is more of the separation of the haves and the have-nots, the people with assets versus the people who haven't yet accumulated those assets, some because of their age or because of their their ability to invest, and others just because of their economic status, and so it doesn't sound, I mean, I agree with you that it's happening. It sounds like it just separates,
and I don't like it. So I mean, I grew up blue collar, middle class, or my dad got a good job, and that good job turned into a great job over time. But in the beginning, he didn't make a ton of money.
Right.
That's my heart. My heart is like strong middle class. I'm even involved in politics here locally to support that.
Right.
So I don't like what I'm saying.
Right.
But we can't discount the fact that it's happening.
Right. Well, and I think that what it does reinforce is that to the extent that you can find ways to be an owner of assets,
yes,
this is now played out again and again and again, that, that's where wealth is made. Don't love it because not everyone has access to it. But the reality is if you do have the ability, maybe think about, fixing your budget to where whatever dollars you could put into owning some of these assets, it's always turned out to be a good investment in most cases.
So look at the S&P 500 over the last, couple of years. It's just right? Yeah. I think that's just going to continue on an upward trend. If you look at it over a long period of time, what's also really interesting is when you take it and break it out, a vast majority of the growth of the S&P 500 is concentrated in the top 7 companies. Right. They're all tech.
The Magnificent Seven.
Bingo.
Yes.
And so there's no reason to believe, let's just say we've started the next, industrial revolution. It's the AI revolution, right? There's no reason to believe or not to believe that people like Google won't keep growing because of that. Matter of fact, it's probably going to help them grow more.
Right.
So if someone is sitting there and they're going, what should I be doing? I don't have a ton. If you're not doing much, you should at least be taking $100 a month, $500 a month, $1,000, whatever you can do, and just shove it into no-load index fund that mirrors the S&P 500.
Right.
You'll start building something which is going to create that problem. I think what happens to a lot of people, at the lower end of the financial spectrum, is they never get started on the journey. So you have to, one, pick your goal, two, create the plan, and three, just get started on the journey of investing.
Right.
And then over time, that can greatly reward you. I'm talking with my son, Isaiah. He just turned 18, and we have a certain amount of money invested for him. I mean, it's just barely.
Right.
But the reality is if he keeps investing, and this is what I'm trying to show him, compound interest.
Right.
If he keeps investing over his lifetime, just a small amount of money, we're talking a few $100s a month, he becomes a multi-millionaire out here by him having the discipline to do that. And so we're trying to build that habit and that muscle today that will help him over the long term. Well,
here's the other thing. When and I didn't plan on having this conversation, but look, the reality is that when you start investing, whether it be with stocks,
Yep.
whether it be considering purchasing real estate or doing something else, what happens is you end up engaging in conversations with like-minded people about those things. So maybe it's, investing in stock, and then you talk to someone who's got a really good stock idea that you didn't
Yes.
know, or they introduce you to their friend who isn't invested in stocks, but's investing in this other thing, which you become aware of. I mean, you and I remember one of the conversations that started us working together was when I was down in Austin. If you remember, we ran into each other down in Austin, and you were at a real estate conference and I was at a different event. And then we spent, a couple hours, just chatting about things, or an hour or whatever it was. And I was like, you know what, that guy's smarter than I thought he was. Like, let's get together when we get back. Yeah. My point is we have common interests. We hadn't previously worked together on any business type of a deal, but then we have a conversation because of our, because we're both interested in investing in the same types of things. Yeah. Then all of a sudden there's opportunities. I'm like, hey, I like doing this kind of stuff. You're like, hey, I have these opportunities. Now we've invested together. My point is once you're in the game, then you don't know what relationships and conversations are going to come about, even if you're investing at the smallest level, but then you're at a work event or you're at a party or something, and someone's talking about investing in stock, like, oh, I'm investing in that stock. They don't need to know that you only put $100 a paycheck in. It doesn't matter, but it leads to other conversations because people that are investors like to talk and network with other like-minded individuals. And if you're not even in the game, then you're probably not in those conversations.
Bingo.
I mean, it's hard to put your finger on what that turns into. It's just, you got to get in the game, even if it's a small amount.
I think, how do I create a weekly or a daily discipline of learning about the financial asset classes that I want to invest in? So on a regular basis, I read financial news, and then I read about real estate, land development, and syndication in large deals. So I spend time learning on that. Okay, well then what's the next step? And I'm already doing all those things, so I'm just sharpening the sword. Well, the next step is you can get into friend groups, networks, but you're going to grow to the conversations that people are having around you.
Right.
So if your current network isn't having these conversations, you need to grow your network. You need to expand your network. You remember your growing up, your mom says, I don't like Timmy. He's a bad influence on you. That's because Timmy is a bad influence on you. You're going to go TP someone's car and steal a hood ornament.
Right.
Okay. But no, if Timmy was a really good kid who was like all of a sudden, like, he got straight A's and Timmy had started 2 businesses and Timmy's in tip-top shape, your mom's like, I love Timmy. Go hang out with him.
Right.
Why did we ever get away from that as adults? Your health, your spiritual life, your relationships, your wealth. Just look at your 5 closest people in your network. Take that, divide by 5, and you're in those categories.
Right.
So I want to level up. I need to go find that person that's above me and befriend them. I need to go join. I need to go to, watch all Tony's YouTube videos. I need to go get in those masterminds. I need to go get in that coaching. I need to go read those books. And then all of a sudden, even if you didn't spend any money, your brain is moved to the next level, which allows you to do the investing.
Right. Yeah. Well, we took a tangent there, but I think it's a good one.
No, it's a great one.
And the bottom line was Asset MeltUp, which you're not a part of if you're not owning any assets. That's, I guess, the bottom line. Last topic I want to hit on really quick is around the idea of a recession. I mean, we have been saying that we are in a recession back 2.5 years ago when GDP was low for two quarters in a row. And it's like, by definition, that's a recession. Then like, well, hold on, that's not really the definition. There's this bureau and they have to say that we're in a recession. Even today, I'm hearing people say, you know, well, we might already be in a recession, or we're in a recession. But you brought up a really interesting idea, which is that maybe there is just parts of our economy that are rolling in and out of recessionary times. So maybe unpack that for a minute, because this was an interesting concept. And I think it falls right in line with why we might be seeing this thing I talked about on one of my previous podcasts that Ryan Hills had mentioned, which is the idea of maybe we're in like the no landing. We have a hard landing or something. We're kind of in this no landing zone. And this idea of a rolling recession seems like it kind of plays in with that.
Yeah. So the idea of a rolling recession is, generally speaking, when the U.S. has gone through a recession in the past, is it's kind of just like carte blanche, it hurts.
Right.
Now, if you ask people today, they're going to say it hurts, but it's not carte blanche, and it's not affecting everything. And so once again, there's this economic idea of a rolling recession, which we may have seen, you know, during the early 90s, of where it hits certain sectors of our economy different, and it hits them for a period of time. So tech, for instance, right in the beginning, we saw tech values drop. We saw massive layoffs. We're still seeing that, but you're also seeing tech recoveries, or tech stock stock valuations recover. We saw,
well, and also in the tech space, I have a friend who does a lot of commercial construction, and a year ago, all they were doing was deconstructing these labs and stuff. And now they're actually back to constructing stuff for Meta and for Google. And you're starting to see that, actually, to your point, come back a little bit.
Then, as most of you are probably in the real estate industry, we know that D-Day for us was the Fed started raising rates in, approximately mid-2022. And then transaction count started shrinking massively, and it shrunk by like 50%. And on your guys' side, it shrunk by like 85.
Well, yeah, because there was no refis.
Yeah.
Right.
So you got hit worse than we did on the real estate side. And then that's slowly recovered, and it's in the process of recovering like we talked about earlier. And we've seen also some of that happen in manufacturing. We're seeing that in other areas. So this idea is the economy is going to continue in this malaise. It doesn't really feel perfect, but it doesn't feel bad. And it kind of hurts because things are expensive. And so it's hurting the consumer. And you go through this malaise, and you can kind of think of it like, we'd like a recession to go down and then just pop right back up.
Right.
This is more like kind of that idea of the Nike swoosh. It went down and it's just going to go up, and we want it to be a nice gradual up, but it does like any market does. Oh, it's great. Oh, crap. Boom. And it's got the ups and downs to it, and that's depending on where you're at is where you're feeling it. We're going to continue to see the rolling recession move through until the Fed cuts.
But the problem is that this rolling recession then does not give a clear signal to the Fed that it's time to cut.
Bingo.
Which is why, you look at certain things, man, I feel like we're in a recession, certain parts of the economy are not strong, but yet it's not showing up in enough of the economic indicators that would give the Fed the green light to lower. So as we're talking about this, it makes me start getting concerned about the idea of like a stagflation, because I always feel like we're going through a recession that isn't considered a recession. And if it recovers, like you're talking about, before the Fed ever did anything, now we have a, recovering economy. The Feds haven't done anything, and we start potentially seeing inflation. I mean, it's kind of concerning, actually, that because it's like an unknown way that the market's reacting, that I don't know if the standard kind of, we're used to this seesaw kind of move by the Fed. And if we don't get that and they don't take action, what does that ultimately mean for us? I mean,
so prior to the Fed meeting, and this is kind of what I love about recording videos, you can go check our batting averages. You can go check what we've said before. I recorded an episode where I literally said on my podcast, like, holy cow, iceberg dead ahead. And I was talking about stagflation.
Right.
I got so worried about it before the Fed announcement. I even was like chatting with my wife. I was like, babe, we might be headed for a really big problem. When they started pivoting, though, and then the market's reaction to the pivot, I think that calmed down the fear of stagflation. And then we got the good CPI number. It's still in the cards, right? But it's not one of the cards that I'm totally betting on. But a month ago, there was 2 weeks I was genuinely worried that's what was happening.
Yeah. Well, the more we talk about it, the more I'm like, that's a possible result of this sort of rolling recession that we're seeing. And I got to imagine for the Fed, it's hard because I watch certain, weekly updates on the market, and it's always like, well, this part of the economy, everything's pointing towards a recession, but then it's always contradictory. And that's been happening for like over a year now. And then when you mentioned this rolling recession, I'm like, it really does kind of feel like that. You can kind of see that where different parts of the economy at different time are having challenges. And then I just wonder what happens if they all kind of work through their recessionary pressures. They all start towards recovery. And now we have a growing economy that still has inflation present and an absent Fed, so I don't know.
It's a real fear. And what's interesting too, so you look at real estate as like a whole sector. Now chop that sector down and go deeper. And so let's look at residential construction versus commercial construction. Residential construction for single family homes is booming right now across most of the United States because that single family home builder is clocking amazing profits and filling the gap from the lock-in effect. And now if I flip it over and go to multifamily and commercial and office and warehouse, that sector is getting beat up. So right inside of a bigger sector, when I break it down to smaller sectors, just two different versions of construction, you have two different tails happening.
Right.
That's going to continue until the rates lower. So what I think is happening and why I don't think stagflation is there, just to kind of tie a ribbon around this, is the consumer is breaking more in the background and the Fed has more data than what they're reporting to us. And so they're seeing the auto loan delinquencies, credit card delinquencies, student loan delinquencies. They're seeing cash reserves in like the M2 money supply go down. And so they're seeing these other indicators where they're going, the consumer is starting to hurt. Because just run a poll.
Right.
Ask 10 of your friends, do you feel like you have more money today than you did, 2 or 3 years ago? Well, the answer is going to be no.
Right.
Do you feel like you're being pinched more? Yes. So the Fed's job is working. I just think that based on how they're reading the data and because the data is confused in the fog of war, that they're behind the times. They're going to wait a little too long and beat us up a little too much before they cut.
Yeah.
Just like they waited too long to raise.
They did. Well, they tend to do this. This is not uncommon for the Fed.
New.
But yeah, and yeah, I think you're right there. I think they will, give a token. I think we'll see a cut sometime this year. You mentioned rents. I don't know if you picked up on this, but rents did just tick up over the last 30 days, which is interesting. Which is not great for inflation, by the way. Great for landlords, but not great for inflation because it had been coming down. There's a trailing effect to, the shelter component of the inflation calculation. So that's not going to play out great for us, but it is happening. Oil prices, up as well.
Wow.
Also not great for inflation. this will be interesting. All we can do, you guys, is bring you real-time information. And that's why, you know, having Anton on here every couple months, talking about the real estate market, what's going on, talking about investment opportunities. And we always love to banter about, you know, pontificating about what we think the Fed's going to do. We don't know, but, you know, it's great talking points. And hopefully you guys find it interesting as we enjoy putting this content together. So if you like this type of stuff, please, you know, we put out a new episode every single Friday at 10 a.m. Subscribe so that you don't miss one. If you have another topic you'd love to see Anton and I cover, he will be back on at some point in the future. And put it down in the comments. Anything you'd like us to talk about real estate related or questions that you may have, let us know. And until next time, we appreciate your time and attention. Take care.